Hello everyone, and welcome to part 2 of this financial planning video series. This video will focus on the overall financial plan for retirement planning. And we'll begin with the consideration of what the overall goal should be in developing such a plan. In the short-term plan, a short-term financial plan, the goal might be as simple as staying solvent and being able to pay your bills on time. But the goal for retirement planning should be more aspirational. So maybe it's something like accumulating enough wealth that you can attain economic freedom. And by that I mean each morning you get up and you decide how you're going to spend the day. For me, that's a reasonable goal for retirement planning. Our first video focused on the Social Security system. Key takeaways from that conversation were: 1, the Social Security system has a 35-year look-back period. That 35-year look-back period determines how much Social Security tax you paid, how many dollars of wages you earned during that period, and that gets inputted into a formula that determines your retirement benefits. That formula can result in a payback of 90% for some of your salary, 32%, or 15%. We also learned that payouts to spouses are independent of one another, so each spouse has their own earnings history. Okay, so the overall plan. What are the elements of the overall plan? First of all, we're going to consider multiple income sources. So some of these income sources may provide a fixed type of return, and other components may have a more variable return, such as would be the case with a stock investment. Our biggest concerns are generating enough returns or adequate returns to accumulate the wealth necessary to fund our retirement. And that is associated with a similar, another dimension or concern, which is risk. The higher the risk that we're willing to take, the more likely it is that we will accumulate our wealth goal. However, there's more volatility as risk goes up, so volatility simply means that uncertainty goes up. And this is February 11th as we're doing this video. The stock market over the past week has dropped about 2,500 points. That's the kind of thing we're talking about when we're talking about risk. So some people in the stock market have lost around 10% of their stock market investment in just 1 week. We're also concerned about the duration of the benefits. We want the benefits to last as long as our life, and we are concerned about inflation.
Okay, so we are going to consider a retirement plan that has 3 component parts. There will be Social Security, and we've talked about that on the first video. There will be a 401k or IRA plan. That will be part 2. And then there will be some kind of retirement cash savings tucked away for a rainy day. We'll call that the contingency fund. Now, we already learned how Social Security benefits are determined. We're going to now assume that there exists this hypothetical couple. They are around 40 years of age, and the household income for this couple is $80,000. We'll further assume that both spouses work to accumulate that $80,000. We won't get into who makes what, but each spouse makes at least $12,000 a year, we'll assume. And together they make $80,000. Okay, so I have some information from the General Accounting Office in my hand here. And this talks about America's dependency on the Social Security system. And the statistic is that for over 50% of current retirees, Social Security provides 2 out of every $3 of retirement income. So most retirees in the United States have some dependence on Social Security, and over half of them have very significant dependence on Social Security. So aspirationally, we might suggest that we want to be in the other half. So rather than being in the half that depend upon $2 or $3 for Social Security, we would like to be in the half that depends somewhat less on Social Security. Okay, so our hypothetical couple, $80,000 a year, and they want to maintain that lifestyle as they move into their retirement years. So we first will calculate their Social Security benefit under the assumption that their 35-year look-back period, that their average earnings are around $80,000 a year. So I've calculated the retirement benefits for that level of income. Again, it will be split between the two spouses, but that's immaterial for the moment. So the total retirement benefit for the couple from Social Security would be $38,000. Okay? Well, if the couple wants to maintain their $80,000 lifestyle, then they need additional $42,000 of income each year during their retirement years. So for this income, we will look to the 401k or the IRA plan. Well, the math is intimidating. The financial experts suggest that of the wealth you accumulate in your 401k or IRA plan, for it to have the duration to last for a typical life expectancy, the withdrawal rate can be no more than 4% per year. Okay, so if we want $80,000 of income and $38,000 is coming from Social Security, we need an additional $42,000. Doing the math in our head, we quickly realized that would then require $1 million plus in the IRA or 401k account. That is indeed intimidating. Another statistic that I can share with you is that only 1 out of 10 households in America has a net worth of $1 million or more. So the likelihood of every retiree, including this couple for whom we're doing the planning, of reaching that level of wealth, it's not high. The likelihood is low. So let's revisit some of the considerations here and see if we can't help this couple out and give them some comfort. So the first thing that I would note is that if they're living on $80,000 currently, they're not actually receiving, if they're earning $80,000, they're not actually receiving $80,000. So for instance, Social Security taxes would take over 6% of their $80,000 income. So that's $5,000 a year. So at most, out of the $80,000 they've earned, they are spending $75,000 to support their lifestyle. So we'll assume that this couple have paid off their home mortgage by the time they retire. So if they have been paying, for instance, $1,500 a month for their mortgage, that's another $18,000 a year that they will not have to pay in their retirement years, and will have no negative impact on their standard of living. So $18,000 plus $5,000, that's $23,000 of their $80,000 earnings that they really would not miss to maintain their current lifestyle in retirement. So that gets the threshold down quite a bit in terms of what we need to shoot for in terms of the 401k or IRA balance. So we're now shooting for a accumulation of something around $500,000 in the 401k or the 401k or the IRA plan in order to support the retirement goals of this couple. And this makes sense. So a broad cross-section of financial experts suggest that the typical retiree will need somewhere between 70% of their pre-retirement income and 80% of their pre-retirement income to maintain lifestyle. So at 70% of pre-retirement income, we're talking $56,000. $38,000 of that comes from the Social Security system, so we need $18,000 or $20,000 more of income to come out of the 401k or the IRA plan. And that requires only about $500,000 in the retirement plan in the 401k or the IRA account. Okay, that's doable. Now, one more thing for us to think about. What happens if one spouse dies? We spoke about on the first video that the Social Security benefits will end upon death. And so retirement income for this couple will be impacted by the death of either spouse, given that both spouses have been working. It's likely that the Social Security benefit of the higher earning spouse could be maintained after the death of either spouse. But in any case, some retirement income will be lost because of the death of a spouse who did accumulate earnings in Social Security and did accumulate a benefit from that. And so there should be a plan that allows an adjustment for the surviving spouse. Maybe it means selling the home and moving to a smaller place, or maybe selling the home and moving to an apartment. But the financial plan ought to take into account what happens if a spouse passes away. What are the options for the surviving spouse? So last thing to talk about would be the cash contingency. So ideally, the cash contingency would equal about a year's worth of earnings. And that cash contingency is set aside for the unpredictable things in life. Things like major medical problem. So there are a lot of medical expenses that are not covered by any existing medical plans and have to be paid out of pocket. Or maybe it's something that happens to a child or other family member and you're asked to help. So if this couple wants to accumulate a cash contingency plan, then my advice would be they need to accumulate about $80,000. That $80,000 can be invested in a safe security, like simply a CD, a bank CD. The objective isn't to maximize the earnings on this cash, it is to provide for that contingency that might happen. Now, one more thing to mention with respect to Social Security and trying to blend that with a 401k or an IRA plan in order to reach a necessary balance to maintain lifestyle. There is the possibility that instead of retiring at the full retirement age, which as mentioned in the earlier video would be 67 for our couple, there could be a decision taken to defer retirement until age 70. Deferring retirement until age 70 has two potentially huge benefits. One is that it allows more time to accumulate the balance in the 401k or the IRA plan. And secondly, you get the higher Social Security benefit. The annual retirement benefit would go from $38,000 to over $50,000. So if this couple needs around $56,000 to $60,000 of cash income to support their lifestyle, getting $50,000 of that from Social Security would imply that they would then only need $10,000 a month out of their IRA or 401k plan. And $10,000 a month is supported by a $250,000 balance in the IRA or the 401k plan. Additionally, I would observe that having these two components in the retirement plan, Social Security and the IRA or 401k, both are to a degree inflation protected. Okay, so that is the simplest outline of a retirement plan that I can offer. There is a simplicity in this plan because there are really just three pieces to it. Social Security, which all of us are hopefully going to enjoy, assuming that the program stays solvent. Then the pre-tax or after-tax savings plan that we get in an IRA or a 401k plan, and then just a cash contingency fund to cover things that are out of the ordinary and that we don't want to disrupt the flow of our monthly income. We don't want to draw down the IRA or the 401k balance to deal with that contingency, so we have a separate fund for that. Now, I'm going to do two more videos, I think, to wrap up this series. I'm going to do one talking about how to manage an IRA or a 401k plan with the purpose of accumulating a certain amount of wealth. And then two, I'm going to talk about the management of debt in a financial plan so that debt does not become an issue or a concern in accumulating the wealth necessary to have a fulfilling retirement. So just to conclude, the goal of retirement planning should not be to maximize your wealth. That would be a relatively poor excuse for working or for living for that matter. But something like aiming for that amount of wealth that gives you economic freedom, that's the kind of aspirational goal I think we should have in our retirement plans. I hope you found this useful.